In this video, we're going to talk about how much of your trading should you automate. Stay tuned. Hey traders, a very warm welcome to you. Okay, we're in this great situation now in the current environment where computers can do a lot of work for us. We have at one end of the scale a fully automated algorithm slash robot that's executing, that's kind of adjusting, doing machine learning, doing its own strategy, improving as we go along and managing money for you, right the way over to a guy who still makes a telephone call to place his trades. And somewhere in between is a sweet spot that suits you as a trader. So what parts of trading can we automate and what should we or shouldn't we automate? Is my opinion on it. Let's have a look. So we have all this functionality, and also now, because most of it's relatively cheap to us, if not free, part of our platform has lots of automation. You know, the services out there, they're very, very cheap. But how do you want to lean? Do you want to lean too much automation or too little? Well, in my opinion, if you automate too much, and I'm saying this from a point of view of a discretionary trader, if you automate too much, you lose what makes you a good trader. And so there's a sweet spot somewhere that takes some of the load, some of the dog work, so to speak, off you and allows you to make the decisions and use your mind and your capacity to make good trading decisions as opposed to doing all the other stuff that goes with it. So let's have a look. So the first one is alerts. This is a big one, guys. And I think, you know, a lot of people overlook it. It's the most simple thing in the world, but people don't use alerts enough. And I think sometimes people are using them wrong. Let's say for example, we have a couple of markets that we want to be alerted to when they hit a certain level, because that's an area we'd like to do business from the long side, for example. And when it hits that level, we want to be ready to buy if other things stack in our favor, whatever our setup may be. So we have this, and most people will say, okay, let me set my alert. I'll draw my support and resistance line in, as they do, and then they put a little bell on it. Can I draw a little bell, Christmas bell? Wow, it's the worst bell in the world, but you get the idea. They put an alert on it. Most of the platforms allow to do that. But the trouble with that, guys, is that let's say you set an alert, and that generally means that you're doing something else. If you're setting an alert, you're doing something else, whether you're away from the screen, whether you're doing something else on the screen. The point is you want to be alerted to it, alerted to that level. And so what happens is the price comes down to it, the alarm goes off, the bell goes off, you rush to your screen or you flick it on, and you feel an impulse to do something because it's a level that you wanted to buy at, or it's a level you wanted to sell a break of, or it's a level you wanted to do something at. And the trouble is the price is already there. You know, you're already right in the thick of it. My trick is to have an alert here. And let's say the price happens to be above the alert and you're looking to buy. You draw a support and resistance line, fine, no problem. But you draw another line and you can make it dash, you can make it kind of thin, you don't have to have it confusing on your charts. You can make it the same color as the chart background. But that's where you set your alert, not this one, so that it gives you time. So as the market's coming to, as it crosses through it, you have that at a decent width. Whether you're swing trading or day trading is going to depend on how much width you give it. And then you say, okay, once I've been alerted to that, I've got time to assess. How has it got to it? What are all my decision-making process, going through everything, all the filters and stuff before, and then you're ready. And if it doesn't hit it, it doesn't hit it. But you're prepared and you're ready to pull the trigger, which is what the whole point of the alert was, as opposed to it being there and thinking, oh, you know, don't pull the trigger, it's going through, it's bouncing off, you're panicking, you're under too much pressure. Easy little tip that, guys, just to put it in and make life easier for you. Okay, so we've done alerts. I think that's a big one, and it's easy to forget about how useful alerts can be because they're just so simple. The second one is screeners. So there's loads of free screeners out there. We've talked about screeners before, but what is the point of a screener? The point of a screener is it's like having an assistant who is just who's getting rid of all of the useless stuff and giving you potentially good stuff. So if you're recruiting somebody, for example, it's like a recruitment firm filtering through all the rubbish CVs and giving you a handful of decent CVs that match your criteria. That's what that is. It's free. So let's say most of the time they're free, or maybe a tiny amount of money, but things like FinViz are free. But this is, for example, if you're trading a basket of commodities, you're trading a basket of stocks, you're trading some indices, whatever, you want to be alerted to specific criteria. It's a perfect thing to do. It's a very binary outcome. Does the criteria match this, this, and this? Yes, then put it into, email it to me, alert it to me, or put it into some sort of group, and then you check it at regular intervals. And again, you can set alarms to do that. So that's a really good way. Another thing is often, and from my experience, if I'm very, very focused on one market, but perhaps I'm trading 3 or 4 markets in the week, I'm very, very focused on one because there's lots of opportunity there and it's very good, it's very interesting. However, if those other markets start to do something specific, like break away from moving average, or have several up days in a row, or down days in a row, or do something unusual volume, I want to be alerted to it. I don't want to be worrying about, is that market doing anything that I'm missing out on something, I'm missing out, and having to divert my attention elsewhere. If I put a screener in place, then I know it's being dealt with and I can focus on the job in hand. So it's a really good tool, that guy's using screeners, very useful. Another thing is something like a position guardian. And what I mean by that is you might have to automate this yourself and stick it into Excel, or some brokers may offer it. Some platforms, they may have to API into your broker. But the point is, what I mean by this is you have something that is looking after your positions. So if you have 4 or 5 positions on, and you're a swing trader, you don't want to be checking them regularly, what you can do is, program this kind of software, or program it yourself in Excel, that just monitors, hey, am I getting an explosion in profits? In which case, do you want to then look at it and kind of take advantage of that opportunity and scale some out? How is my overall position? Am I getting explosion profits on all 4? Am I getting one I need to perhaps take out? How are the others? And you can add these kind of things in. Again, all you're doing, it's a very binary outcome, and you set your own rules. But the point is you're not constantly looking at it, because you think you don't automate this. You're looking at alerts to see you can see what's going on, because you haven't got an alert. You're looking at screeners. You're looking at this. You're looking at that. You're not focusing on the trading. So that's another good one to look at, guys. Some kind of position guardian setup. I say whether you do it customized or find some software to do it for you. The final one isn't really automation, but it's very, very simple. And actually, again, it takes a lot of the load off you. Automatic orders. So, you're staggering your orders in the book, or limit orders in, and you're using OCOs to get rid of your stops as well. It's just the smallest little thing, and most people do it already, but it just means you haven't got to worry about it. You know that, hey, if I haven't got an open position, I haven't got any pending orders in it. If that order gets filled, then that order is going to get activated. If that order gets filled, then that order is going to get cancelled. Utilize it. It's easy, it's simple, but many of us don't. We still want to do it manually, and mistakes can happen. But utilizing the ability of the computers and the kind of software out there, and the fact that it's cheap or free even, means we can take a lot of the stress away from us, a lot of the cognitive load, and just focus on making good trading decisions. Guys, if you've got any thoughts or comments about how else you automate things, I guess the final one which I haven't included is real-time alerts. If you're trading stocks and stuff, there's software out there that will alert you if something's suddenly moving quickly, so you get alerted to breaking news. A very good way of automating stuff as well. So anything else, guys, stick it in the comment section below. As always, good trading. Keep the risk managed. Take care. I shall see you in the next video. Goodbye.